As a dentist, doctor, or small business owner, you're probably feeling the weight of balancing your demanding practice with your personal life, right? It's tough to find the time for family, to focus on your health, or even think about your financial future when you're always grinding away at work. To the Dr. Josh Cochran Show, where I'll focus on empowering professionals like you to build passive income and achieve financial independence through real estate and smart investment strategies. Each episode, you'll discover practical steps and real-world stories to help you create long-term wealth and gain more time to focus on what really matters: health, family, and freedom. You're ready to break the cycle and start living on your own terms. This show is for you. Part 2. With me today is the wonderful Dr. Reed Faldet and the very intelligent, and I'm interested in getting him to know him more, Dr. Andrew Welling. Welcome, guys.
Good to be here.
Thanks. Yep.
Okay, our first quick segment in the news. So interest rates, I don't know if you've noticed, have dropped. Why have they dropped? One of the top Fed guys, not Jerome Powell, after the last meeting was like, we need to cut rates. And so the market has responded and rates have dropped over 100 basis points already. And so what people are doing, the market is anticipating a rate cut and reflecting that in the rates. So we talked about rates last week, how Europe, Switzerland's at like a 0% already again. So the market's anticipating cuts in rates. The second thing that just came out recently was, I talked a few weeks ago about Jerome Powell. Scott Bessent, the head of the Treasury, wanted to cut. He's been talking about for the last 3 months, cutting restrictions on banks. And we put some extra restrictions on banks in like 2018, 2019 to increase their, the exact term is the enhanced supplementary leverage ratio. It's just like, how much do they need to have in reserves? We kind of put extra reserve on the banks, kind of restricted them a little bit. So for banks and bank subsidiaries, they're opening that up. So from 5% to 3.5% to 4.5%, and then for subsidiaries from 6% to 3.5% to 4.5%. What does that mean for you? If you kind of free up banks to do more lending, put less rules on them, they're going to do more lending. And oftentimes rates come down. As I mentioned, Scott Bessent was predicting about a 60 basis point drop in interest rates. Nothing to do with Fed, purely from them cutting restrictions on banks over time. So this is action. This is happening. So this isn't just talk. So this is more momentum for interest rates going down, which makes it easier to finance real estate when you're trying to buy stuff, so, or refinance. So it's good news. All right. So any comments on those two news topic items, or any other news that you guys want to talk about, Reed or Andrew?
How does the chair speaking about interest rates lower interest rates without actually affecting the treasury market or the federal funds rate?
Yeah. So when you think about the stock market and any other markets, it's all perception. Okay. It's all perception. And then it's like net present value calculations, right? So
Okay.
when you see like Musk make a comment, or Trump must make a comment, and Tesla stock jumps or drops, right? That wasn't from some like financial analysis. That was these guys just saying something, right? And market sentiment moves. And you have two types of people. You have like the unsophisticated investors who are just like betting money, right? And those people move. And then you have like the sophisticated folks who are taking that data, putting it up into their models, running the numbers, and then saying, okay, this is where we think things are going to go. And so when you have a proposed drop in rates, people like institutions will put that in their model, and it'll say like, okay, like if we bet this way and this is more likely to happen, they start demanding it more, and then the demand increases, and then the rate that you
So
need to offer to get people to buy the treasuries goes down.
okay.
This is a little more complex, but it's shouldn't have gone that deep.
So,
Without having 10 minutes to explain it and a model.
so if I'll try to quick. So
Yeah.
essentially what they're trying to do is get ahead of the anticipation of rates truly dropping either through the treasury market or the federal funds rate. And people are anticipating that drop. So they're going to price the retail interest rates accordingly. Like,
Yeah, that's a much simpler way to say it. Yep.
okay,
Yep.
okay. That
Yep.
kind of makes sense.
Just think of things as like a popularity contest. Okay. There are institutional people crunching numbers, but by and large, like our markets nowadays, with the way information gets disseminated immediately, right?
Yeah.
Through X, through news stories now, like yeah, it's
Yeah.
like a popularity contest.
Yeah.
Um, Okay, today's topic, how to build wealth fast, part two. So Lynn Alden is a wonderful blogger. She puts out really good content. She released an article, How to Build Wealth Fast. This chart shows what it takes. We went over the first half last episode. Please listen. It was fantastic. How to build wealth. Talking about increasing the difference between your income and your expenses, saving that difference. And then she talked about increasing your income, right? High paying job, side hustles. We went and evaluated all these concepts, gave our opinions, start a business. And then we talked about how to achieve like growth rates with your savings, right? The low end, 0 to 3% treasuries, corporate bonds, municipal bonds, savings accounts. Then we talked about 3 to 8% returns, preferred stock, peer-to-peer lending, index funds, how to produce 8 to 12 high yielding dividend stocks, emerging market stocks, so kind of more like gambling, real estate investment trusts, some years, uh, some other complex concepts that I don't want to go over in this show, how to produce 12 to 15% annually, top quartile private equity. So not all equity, private equity, just the top percent. And then direct real estate investing, right? And Reed and I mentioned, and Andrew, like this is why we do this because we've seen this, right? With our hands. We put money in and we get returns. And personally, I don't know Andrew's, but Reed and I's returns are much, much higher than 12 to 15% annually, right? So, when you know, go eat a snack and you really like that snack, you go back for more snacks, right? And so that's been our experience with real estate. And then 15% plus annually, she mentions be a world-class investor or start a successful business. And let's talk a little bit more about this. Reed, do you want to start about these two pieces to our top tier, the how to produce 15% plus annually?
Yeah, yeah, sure. So yeah, just to quick summarize and keep it really simple. It's essentially the formula here is maximize your income, maximize your savings rate, right? And then maximize the returns on your savings. It's like kind
Yep.
of those three concepts. So we just kind of laid out the different return profiles that you could get in different categories of investments that fall underneath that, okay, maximize return bucket, right? And so that's where we're getting in right here.
And we went pros and cons of both
Pros
and
and cons.
kind of
Yep.
our personal experience, right? Not just superficial level. It's like, listen, this is what we've seen and what we've learned. So yeah.
And you have you guys ever watched? There's this guy. I think he's on YouTube and TikTok, but he basically like goes in wealthy areas and asks people what they do for a living. Like, right? There's a person on
Yeah.
a yacht or whatever, and like almost without fail, like, do you guys know who what's typically like the wealthiest people on the yacht? What do they say they do for a living? They're like, how did you make your money?
Business owner.
Yeah.
Almost
Business
always,
owners.
yeah.
Hmm.
It's like I develop real estate, which is, I mean, if you're a real estate developer, you own a business, right? Or I grew this huge company and then either sold it or still operate it. That's kind of like the two buckets.
Yep.
And so that's kind of starting that successful business is that big bucket. And then the other side is like being a world-class investor. If you think of the top hedge fund guys, everyone mentions like, well, Warren Buffett technically isn't a hedge fund, right? But Berkshire Hathaway, right? World-class investor. Everyone looks up to him. And then I think Peter Lynch. And then who am I missing on? Um, the world is ending guy that
Oh, Peter Shift.
yeah, I think that sounds yes. I think that's right. So
Is that right? Yeah.
I think that's correct. But essentially these world-class investors, just one thing I want to touch on it is you can't achieve these returns of, let's see, I think Berkshire Hathaway averages 19% annualized returns. I think Peter Lynch through his Magellan fund was close to 30% through his time. You can't achieve those returns without leverage or without investing on margin. And so basically what they're doing is they're borrowing money to invest. And most retail investors don't do that because it's very hard and very risky to take out leverage on a very volatile asset like a stock because at any given point during a day, that price can go up and down, up and down. And so the volatility of it makes it risky because at any point, whoever is lending that money out to you can call that note due if that value drops lower than what their threshold is for lending. So you have to use leverage in any type of generating a good return. Like we talk about in real estate, the only reason you can get 15-20% plus returns in real estate is typically because you're employing leverage. And so the same concepts apply in the stock market. And so what I just wanted to parallel between the two is the nice thing about real estate is it's not doesn't have a ticker price on it all the time, right? And so there's not as much volatility in the price of real estate, and therefore it feels safer and more stable to take out loans against real estate than it does against loans against your stock market portfolio. So I just wanted to kind of drill down on why those high returns exist within those world-class investors and how you can kind of parallel that with real estate and kind of the pros and cons of each.
Hmm.
Yeah, no, that's great. And I also think she goes into that last 15%. It's world-class investors and it's business owners, and she puts this caveat of you're much more likely to hit the 15% being a small business owner or than trying to work to become a world-class investor. The level of sophistication and the access to deals and assets, it's the chances of any of us being those things, but it's good to learn from them and see kind of that they use those same principles that exist um, or are available through direct investment in real estate to be able to get some of those types of returns.
Yeah. I think she uses the word world class investor on purpose, right? It's like saying, okay, if you're not LeBron James, right? Or
Mhm.
like the Michael Jordan, like you're not the top of the top, like 0.0001%, you're gonna get slaughtered, right? Like that's what she's saying.
Yep.
And whenever I look at Warren Buffett, he's not like a stock picker, right? He like dives into these businesses just like we dive into a dental practice, right? If we were going to buy a dental practice, we go follow the dentist, right? We get to know his team. You look at his financials. You look at everything, all the KPIs, right? And I can go into any dental office and I'm probably not going to be fooled, right? Like I understand what's going on, I understand their strengths, their weaknesses, all that kind of stuff, so I can make really good decisions about whether I'm going to buy a dental practice or not. Warren Buffett is similar. Okay, so
Mhm.
if you don't know a business as well as you know a dental office, you shouldn't be buying businesses.
Fair.
Okay. So I think that's like the point here in world-class investors. Like until you know businesses like that, all the time people send me something. Hey, what do you think about this startup? Hey, what do you think about this business? And I'm like, it would take me at least 2 years to become like an expert in that business.
Yep.
So like, why am I going to waste my time investing in that, right? Investing that time. Like I already know dentistry well. Like I can invest in dental offices. I know multifamily well. I know retail well. I know office well, right? Now, real estate's a little simpler than dentistry in my mind. So you can learn other real estate assets, but so that's one point I think that people need to take home. Is like I see all these people talk about stocks. What are you investing in? Oh, this one's low. Is this one undervalued? Let's buy this one. Like I went honors finance at University of Washington, right? Just get latest rankings. Number two public university in the country or in the world, I forget. But University of Washington, like great strong business finance program. And like it got drilled into me, like you can't beat the market, right? If you're gonna do stocks, just do index funds, right? Lower your costs. Don't do some financial planner who's gonna increase costs on you. Just do index funds, right? Like you can't beat the market. So if you can't beat the market, then you know your returns are gonna be like on average historically like 8%, right? I mean, that's just it is what it is. So stop trying to game the system, you'll just get killed. And if you do leverage like Rita was mentioning, right? Like how these guys have done it, they understand the businesses, right? You're not going to understand them like they do. You're going to get killed even more if you do leverage, right? So don't think of stocks. It's gambling. Stock investing is gambling. You are going to lose money. The house is going to win, and that's been proven historically over the years. You'll have some wins that make you feel good. Eventually, you'll get slaughtered in the long term. Okay, and it's not just you; it's everybody. It's me. So I don't do it. Okay. So, how to produce 15% annually. You've heard Reed say this on multiple episodes. You've heard me say this on multiple episodes. This is how wealth is built. Okay. A business. It could be a real estate business, it could be another business, right? But that is how wealth is built. All the wealthy folks in this world, you start naming them, first ones that come to mind, right? Elon, um, you know,
Bezos.
Bezos. I mean, you
It's
just
on.
Bill Gates. I mean, you just name them, right? Business, business, business. Um, you look at family offices, right? Grandpa had a business, right? Great grandpa had a business. And then family offices, the average annual return for a family office, very sophisticated, right? They have a whole team, attorneys, accountants, financial planners. Average annual return, 7%, less than index funds. Okay. Private equity firms right now, cost of debt went up. Private equity firms are getting slaughtered. Their values are down, last time I looked, like 30% over the year. Right.
Yeah.
So it's if you want to build wealth, you need to, if you want to build wealth slowly, preserve wealth, right? Like help maybe beat inflation by a little bit, index funds. Okay. If you want to increase your yield on your investments more than that, real estate. You can control it much more than these other asset classes. If you want to grow real wealth, start a successful business. And most of us are dentists, right? And so that's why when we say, hey, what's your income? Oh, it's 200,000. Oh, it's 300,000. Okay, number one thing, like take a bunch of CE, right? Go learn dental insurance. Go learn to sell. Okay. And I don't mean sell things people don't need. Like go learn to communicate with patients. We have the worst sales close rate out of like any industry, right? Because you don't know how to talk to people, right? So like learn those skills and learn the technical skills, whatever skills you want to learn. I mean, you don't have to learn implants. You don't have to learn these other things, right? If you just know the business of dentistry and how to talk to people, like you can just do crowns and fillings all day and make great money, right? And how to run a team efficiently. I think Reed, I think your model's more like that. So like those are the keys that I took home from this, that I want like our colleagues, our friends, in dentistry to take home.
Can I
Thoughts?
say one thing about starting a business? Why it's so powerful is you get paid twice, right? You get paid through the profit generating aspect of the business. So you make that business, you grow it, you build a higher income within that business. So every year that you improve performance on that business, you're getting a higher income, right? Taking distributions from that business. But the second way you get paid is the more profitable the business, the more it's worth. And so you are also building equity in the business. And
Yep.
so that's kind of what we talk about with real estate as well, is you get, if you improve a property, you improve the cash flow on it, you get paid that way. And the second way you really get paid is you're improving the property so it's worth more. More cash flow it produces, the more it's worth. So you get to win two different ways. And that's with having control over something. You cannot make Microsoft, Apple, Amazon more profitable because you have no hand in that. And therefore you are just giving them your money and hoping that they can do that for you. So, and that, investor sentiment is that it's worth the 20, 30x multiple of earnings or whatever that it is at the time. So yeah, just wanted to double click on that business side, why it's so valuable.
Good points.
Yeah.
Andrew,
And
anything else before? Yeah, go for
yeah,
it.
just kind of when you were talking through, that 15%, it's people with a passion for whatever they're doing and a unique skill set to be able to add that leverage, you know, and so you have to be able to go in and understand something enough that you can impact it, and that's where some real synergy can happen. So our businesses in the dental field, if as you get in and you really understand the, you know, a multifamily project and you see those levers that can be moved, and so I think those people who are really getting the highest returns have that synergy of knowing, not only being passionate because they're willing to put in the time and effort it takes to learn and understand that industry as you were discussing. So it's not just gambling, you know where you're at, but you can also use your unique skill set to try and help increase and actually impact the value of those assets.
100%. And if I were to summarize that with math, okay, you're 1 to 10 on the skill level in that industry, and you're 1 to 10 on the passion level,
Hmm.
right?
Oh,
And if you're a 10 on the passion, you're a 10 on the skill, you're 100, right? So your results are probably going to be very good. And if you're like a 4 on the skill level and a 4 on the passion level, you can say a 5 and a 5, middle of the ground, 5 and 5. You're at a 25, right? You're not halfway, you're less than halfway. So
hmm.
those two skills, it's like exponential, right? Like learning
Mhm.
those two things. Sorry, not those two skills, the skill and the passion. Passion is curiosity, it's grit, it's relentlessness, right? Like
Mhm.
this bothers me and it's usually a problem, right? It's usually some sort of problem they latch onto. For me, it just ticked me off. The dentistry was so dentist focused, right? We're open 8 to 3 Monday through Friday, right? Like that ticked me off when I was a young dentist. I'm like, we're supposed to be serving our patients, right? Now, don't get me wrong, it's brutal on a family to work long hours and weekends, and it's really not sustainable. But that was something that was a problem that gave me that passion, that grit, right? I really honed in on a problem. I tried to find a problem I wanted to solve. And then the skill side, like you don't need to start at 10, right? You just need to commit to growing, to getting better every year, right? You're a 1 when you get out of dental school, most of us, then a 2 and a 3. Like commit, take the CE, surround yourself. How do you learn, right? You find mentors. That's CE. Okay, that's one way to learn. The second way to learn is a peer group. That was the number one thing for me. I just found a great peer group of awesome other entrepreneur dentists, right? That's what helped me the most. So it wasn't just the CE, it's finding that peer group. And then the third is mentoring others, right? Giving back, right? Like you're gonna find go-getters who are younger than you, right? And you're gonna learn from them and they're
Yeah.
gonna give you energy and it's synergistic. So
Yeah, that's a good way to
Yeah.
ignite it
Yep.
when you get to help somebody else. Like when you kind of like sometimes I lose a little bit of my passion around practice management, business stuff. But then if I have like a young dentist that's like, how do you produce that much? Like, how do you get this? And I'm like, oh, let me tell you. And then it like kind of resparks the passion a little bit that you kind of start to lose because you're like, gosh, yeah, I guess I can help someone with that skill that I learned. So yeah, it's kind of interesting how it works.
it's fun. I have a young dentist that I coach. I just love it. He's got a unique business model, right, that has not been tapped. We're like looking at locations for him and like just planning like the debt side, how we're gonna scale it, and it's just super fun, right? Because you're like it's like that new business. It's
Yeah.
it's super exciting. Anyways, I enjoy it.
Yes.
Um, Okay, so Lynn's next thing. So now that we've gone over the tiers, she's got 3 more areas to cover. So one is how to produce investment income forever. So we'll talk about that. 3 wealth building examples of how to get rich, and then 5 tactics to build wealth fast. So the first one here, how to produce income forever. So this is typically like if you're earning like an X per churn, it's like what calculating your withdrawal rate, right? If I'm done, like I'm done, I'm retiring from the dentistry, I have $5 million. Is it enough? Right? This is basically talking about this question. Um, so this is a common question and a common topic, not just for dentists, but everybody in life. Reed, what are your thoughts on this?
Yeah, when I first started going down the investing rabbit hole years ago, when I read the Simple Plan to Wealth or Investor for Dummies or Beginners, like all those ones that basically drill down this concept of you figure out your nest egg based on a withdrawal rate, safe withdrawal rate of 3 to 4%, and then based on how much you need per year to live, right? Essentially, that's kind of how you back into it. So,
Plus, you got to add in inflation too, right? Your
yes.
buying power goes down. Yep.
Yep. And I feel like when I first learned, it wasn't talked about as much on the inflation side, or at least I didn't pay attention to it. Now, obviously, that's a big part of it. So we have to keep that in mind. So I like to keep this relatively simple. I don't really, I'll let you guys kind of chat on it a little bit, but I was just talking to another orthodontist the other day, and we were talking about this concept of like the nice thing about real estate a little bit is that you don't have to liquidate parts of your portfolio to get that consistent, 5%. So that's one thing I didn't love about the stock market, even though I invest in the stock market, I do in our index funds, like we talked about. The concept of a 3 to 4% withdrawal rate means that you're actually liquidating stock because you're probably not all dividend paying stock that are going to produce that 3 to 4%. And so you got to keep that in mind as you're thinking about your withdrawal rate. The thing about real estate is if you can earn 5% cash on cash or something like that, right? You're ahead of the withdrawal rate on this and you don't have to liquidate anything. So you get to maintain that equity. So that's just what I'll say on this for now.
Yeah. One thing too, I think going back to the difference of having something in real estate opposed to having it in the market, it's if a lot of times people run those calculators and they just use a lump sum and they're withdrawing from it. But with the market volatility, if you have to withdraw when everything's down, and then you take out, you've reduced that power of your investment, and so it's not near as clean as you think it is, because if you're having to pull out that equity in those down years, you've lost that growth potential of your stock investment. And so you actually don't have as much power and longevity in being able to just withdraw from the stock market if you're having to pull out in those dips. And so if you have things like real estate that are making it so you are able to continue to grow that nest egg and not really impact your ability to have enough money when you retire. So I think it can be oversimplified that you're always going to get an 8% return, but really it's a 15% one year, and then it's a 1%, and it's an up and down, and that really changes how that 4% rule works in the long run.
A great point, Andrew. Okay, so two main points here that I have. One is this is built for the non-entrepreneurial employee or just like checked out mindset. Okay, this is like, where do I need to get to so I don't have to work and I don't have to think about money? Okay, most entrepreneurs are A, never going to stop working in some form or fashion, and B, they're not going to be checked out on their money, right? They're going to be actively taking a look at it all the time. And so this whole concept is just for like, yeah, it's just a non-entrepreneurial mindset. So it doesn't really relate to, I think, people listening to this show. The second one is Reed mentioned real estate cash flow. 100%, right? You're not having to sell your properties to receive this cash flow. So your wealth is actually continuing to grow. Whereas with stocks, your wealth is shrinking as you're doing this model. The second thing to think about that I like to cover in real estate is real estate cash flow when you acquire something is usually not that high. Okay. Somebody is going to sell it at a price that they think is fair and the market thinks fair. And so your cash flow at the beginning is usually not going to be that high. Well, the great thing about real estate is you have money that goes to expenses, overhead in real estate, okay, especially multifamily. About a third goes to real estate to a quarter. And you have money, the leftover money, let's say 2/3, okay? Well, that 1/3 that goes to expenses, well, expenses grow, so it'll grow by about 3% a year on average. Okay. And you're like, oh man, my expenses are growing by 3% a year. Dang it. Well, in dentistry, that really sucks because our revenue per procedure doesn't really grow. So that eats at a dental business. But on real estate, that 2/3 of the money that doesn't go to expenses also grows by 3%. And that 2/3 is twice as big as the 1/3. Okay. So every year, on average, your cash flow is actually growing. And not only is it growing, that 3% is compounding. So over the years, it goes like this. Okay. That's why when you see, little old ladies that have owned real estate for 20 to 30 years, that's my favorite avatar, right? The wealthiest people in America are widows, right? Like 70, 80-year-old widows, right? Well, they own all these assets, and in real estate, they just keep growing cash flow, right? And these are cash cows for these women. Or 25, 30 years later, you don't have to pay debt anymore. You've paid off your loan, right? And then these are massive cash flows,
Yep.
cash cows. So the concept here is get your income as a dentist up first, okay? And then get into real estate and get into real estate early. So by the time you're ready to retire, huge cash flow. When people say, hey, I want to buy some real estate, I'm like, okay, are you looking for yield? Are you looking for cash flow? Are you looking for an ordinary income tax shelter? Are you looking for a capital gain tax shelter? Those are the four problems that come to me most. When they come to me with the cash flow problem, right, I'm like, hey, we can start here, but you got to understand cash flow in real estate comes from time in real estate. It's not, hey, I put the money in and now I can replace my cash flow. You can get some cash flow, like Reed said, right now with interest rates, most deals are negative cash flow to 2%. If you find decent ones, like good ones, usually about 5%. It's very rare to find like a 7 to 9% cash flow deal right now. Very hard. Like you got to look at thousands. And we do that. Say no to the good so you can find the great, but these are the realities. So get into real estate earlier.
And I could give a very specific example on that. So
Okay.
a property I bought like 3 years ago, a retail strip center for around 4 million, 4.5 million, something like that. So this concept of like cash flow growing over time is crucial because what I kind of didn't think about is we think, we're raising rents 3% a year, but what you're doing is 3% off of the previous year and not from that original rent rate, right? So that's where that compounding of just that works. And you don't really think about that at first and how much that actually affects your cash flow. And so when my debt has been the same since I bought that property, but every year we're boosting those rents and it's a triple net property. So those expenses are covered anyway. And so, I mean, when I first bought the property, maybe it was cash flowing 110,000 a year, like after debt service. Now it's like 160, right? And so it's increased quite a bit. The other side of that is at the end of 20 years, if I hold on to this property, right, that property is going to be appreciating 3% a year, right? So it's going to be going from a $4.5 million property to something like a $7 million property that'll be paid for. And then on top of that, if I assume even a terrible cap rate, right, like it's probably going to cash flow $700,000 a year because it's just paid for. There's no debt, right? This is just trying to be conservative. So that's like showing you the example of like one property doing nothing besides holding it for long-term upkeep, right? Making sure that it's leased, and there'll be ups and downs, of course. But like at the end of 20 years, that's what you have, an income. That's pretty solid cash flow as that kind of creeps
It's
up like that.
it's so good, right? It's solid, right? Like you're gonna achieve that. Like Reed, how old are you? 30,
32.
32. Okay. So let's say you're 50, right? And you're good, right? Now let's not compare ourselves to Reed. Reed is very ahead of the curve. Let's appreciate Reed and learn from Reed. Right? So one is that. That's a great piece, right? So you got that 3% compounding, right? He's gone from 100, 110 to 160, just like 3 years, right? Like that's going to grow even faster over time because it's compounding. Okay. The other piece to this to think about is when you have this long-term mindset with real estate, not the 3 to 5 year private equity burn and churn real estate. You have that long-term 20-year real estate. During that 20 years, there's going to be a time when interest rates drop. Okay. We don't need it to be next year because we don't think like that, right? We buy cash flowing fundamental. We do real estate with good fundamentals. We're not banking on appreciation. At some time, that interest rate's going to drop. REIT could lock in a very long, like 25-year, maybe even 30-year with like an insurance company, low interest rate at that time. He can take all that cash out tax free, right, with his refinance. And then you can invest those into more properties. And that's how you really count, compound, and snowball real estate. Good?
Yeah. Yeah.
All right. Three wealth building examples how to get rich. Uh, we don't need to spend a lot of time on these. Roth IRA growth, 401k growth, and then business growth. Um, in her example, she started with Roth contributions of 6K a year under 50. It's a little higher now. And if we annual average return was 4% in 30 years, you'd have 200K. And at 10% annual average return, you'd have 537K after 30 years. Okay. The next one is 401k. This one's contributing 19,000 a year at 4% over 30 years, 655K. And at 10% return, 1.76 million. Okay. And then a business example, putting in 100K to start your business and then growing that by 15% after 40 years, you'd have 10 million. Okay, so we've got some numbers. We've got at best 537 for a Roth, at best 1.76 for a 401k, at best at 10% returns, and then business at 10 million. Anything that you guys want to touch on here?
It doesn't get you too excited, does it? Not as excited as you
No.
want to get it, right? I think that's the point.
Yeah, I mean, once again, I think it shows the value of how a little change in return can make a large impact. Maybe if these numbers themselves aren't the thing that is really exciting, maybe looking at the difference in the numbers between a 4% and a 10% return, as you scale that to larger numbers, that all of a sudden starts becoming more exciting. And so I think the value there is just that impact on rate of return, what it does for wealth generation, maybe more so than the Roth or the 401k itself.
I think one thing that's fun to see, or at least you can see, is even between the Roth and the 401k, the big difference between 500,000 and 1.8 million is just because you're saving and investing more, right? The annual contributions to a 401k are almost 3 times higher than the IRA, right? And so that's why you're seeing that. But that just shows you the power of investing a larger sums over the same period of time as well. That's that one variable, the other variable.
No, I think that's good. You save 3 times as much in this model and you have 3 times as much at the end, right? A little over 3 times as much. Compounding helps a little bit. The one I have, the slide I always show people for real estate, it's similar. If you put stocks at, let's say, 9%, right? 200K a year for 25 years, you're at 19 million. Real estate, 16% annual average return, 25 years, 200K invested a year, right? 61 million. So it's both numbers, right? One, how much are you slogging away every year, right? And then two, what asset class are you putting that in, right? Like well underwritten fundamental real estate on average 16% a year versus stocks, 8% historically, 10% the last 10 years. So I just threw 9 in there, but triple, right? So yeah, I think it's not, and stocks are good because they're liquid, right? And they're simple if you're doing index funds, but a Roth and a 401k aren't liquid. That's another thing people need to think about, right? So one of the major advantages of having stocks in your portfolio is the liquidity. It's not there in those two, right? So I like a Roth. I use Roths, but a
Mhm.
401k I won't touch. Like I'm not interested. I try to exit 401ks whenever I can, just because you lose that liquidity. You're paying fees. Yeah, I'm just not a big fan. Um,
There was someone in a group in the dental investment Facebook group that made this big post on why you should never invest in retirement accounts. And the big thing that you're losing, especially within a 401k, is step up basis and tax loss harvesting, which hasn't applied to me or I've not utilized, but
No.
but he made that point and I was just like, I'd have to look at this a little bit further to like understand that. But do you have any, Andrew or Josh, have you done any research on that? I can't wrap my mind around that concept just yet. If not, we can always do a deep dive on a later one. But
Yeah.
I just thought I was like,
Yeah, if you are into stocks, tax loss harvesting does work. Okay, it helps increase your returns a little bit, but you got to be like all in stocks. And we've already proven to myself that they're a inferior asset class, right? In general, doesn't mean you can't have them in your portfolio for the liquidity and simplicity. I have no problem with them, but they're inferior asset class, right? So why do I care about optimizing an inferior asset class? And number two was the step up in basis. Again, real estate has a stepped up in basis, right? So this proves again that real estate is a superior asset class. So yeah, those are my two thoughts on those 2 points. It's like, yeah, when I read that, I'm like, yeah, that's why I'm in real estate. I feel bad for all the dentists reading these posts and thinking they can gamble their money on individual stocks and get rich, right? Like, yeah, you'll hit some winners, but then you'll also get slaughtered at some day. And when you do get slaughtered, the hard part is you'll build up like 50K. You'll turn 50K into 300K, right? And you'll turn 300K into 700K. And then that 700K, you invest it and it gets destroyed. And now you're back at 100K, right? So even if you win 5 times, you just lose one time and you get absolutely destroyed. So, yeah.
yeah, what's Warren Buffett's rules, right? It's 2 rules of investing. One is don't lose money. Rule number 2 is see rule number 1,
Yeah,
right?
no,
Isn't that like,
100%. Yeah,
isn't that kind of
yeah.
the joke?
If you're nailing stuff and then you just lose them, it just crushes you. So that's why I like real estate. Yeah, things might go down, right? But if you put fixed debt on it, right, and you have adequate cash reserves, right, you're not losing your properties, right? So the value's over there. So you're not going to zero. Stocks aren't that way,
Mhm.
especially leverage stocks. Okay. All right. Next piece from Lynn, 5 tactics to build wealth fast. Pay off high interest debt now, establish an emergency fund for liquidity, mercilessly cut spending on things that don't serve you, seek out higher income streams, invest money as soon as you get it. All right. Andrew, you want to go first this time?
Yeah. I mean, when you get into those, all of a sudden you kind of feel like you're getting into the Dave Ramsey, some of the approach, and it's good. It's just like good, solid basics. We don't want the high interest rate just eroding and our return the same way that we're getting excited about higher interest rates with our return. We don't want that working against us as far as other things. Uh I do think specifically with that. Oh, I mean, hopefully most of the dentists we aren't writing high credit card debt or something, but that's such a common thing, especially with newer practitioners, is that student loan, and a lot of the student loans these days are getting that 6% or above and trying to figure out what it is. And I think that while these principles apply well, that with paying off the student loan, going back to the 401k or the Roth, don't lose the opportunity to get financed for the practice, which is going to give you a lot bigger shovel to get out of some of those things. So, I mean, as I look at those first couple points, I think they're very valuable, but also keep it in context with what's going to get you to the highest income the quickest, and don't burn all of your liquidity trying to follow some of these basic financial health principles when in the long run it could hurt you.
Is Andrew breaking up for you too, Reed?
Yeah, Andrew, you sound like you're
Yeah.
talking. Oh,
Turn off
fell
video. There you go, bud. Thanks. Okay, Reed. How about you? What are your thoughts?
Oh, can you hear me?
Now we
Yep.
can. Yep. Um, so I feel like this is like financial advice for maybe people that aren't like financially minded sometimes a little bit. And it's all good advice. I'm just trying to think for myself. So I always view debt like, so pay off high interest debt now. So like I don't have any debt that is not business debt, right? So I just don't believe in consumer debt, like almost period. So that's just like a good rule of thumb. So I don't even really spend much time thinking about this. Now I do have some student loans, and oftentimes when I think about debt and whether you should pay it off or not, I'm just looking at what my opportunity cost is to use that money towards that debt versus investing it. Because oftentimes, if I feel I can generate a higher return on my investments than paying off that debt, then I'm going to take that spread. And so but that's not to say that if there is not an opportunity to invest, then I would maybe shift and pay off that debt. So it just depends on, what opportunities you have to put your money in whatever asset class or investment you're putting it in. Do you consistently generate a return that exceeds what the debt that you could be paying that down on, if that makes sense? So like for me, I kind of notched all my student loans down to like that 5% or less. And now I'm just like leaving those because I can invest and generate way higher returns than that. And also, Andrew made a point of like, there's this liquidity element. So I always need to keep so much cash available because I want to be able to pounce on real estate deals when they come up. And so I could just pay off all my student loans. We could do that. But then there's a huge opportunity cost there. And if, like Andrew said, if you're looking to buy your practice or buy a practice or do a startup and you need that liquidity to level up your income, then you don't want to burn it paying off student loans and then not have the opportunity to buy that practice, increase your income, and now you have a big shovel to dig yourself out of that debt if you want. So that's just kind of on debt and kind of emergency funds and yeah, kind of my overall kind of thought on it.
Okay, what about the other points? Did you want to cover these or anything?
So we have mercilessly cut spending on things that don't serve you. So, Andrew, in our first call, you kind of talked about, right, like we're talking about like budgeting and, like figuring out what your burn rate and all that is. I'm like a reverse budgeter. So I like put all my money into investments first, and then whatever's left over, we're free to spend. And so, I kind of like, I basically just take half our income off the table and just put it away into like a savings or high yield savings account so that it's like I'm poised to invest and I have all my automatic withdrawals set up. And then whatever's left over, I don't feel guilty about spending. And so we don't feel like we have to have a budget. And so it's smart to think like this, but one of the big things that can kind of just free you up is if you can have enough margin where your income far exceeds what your lifestyle expenses are, you don't have to really stress so much about this, which I think is where we all want to be. I don't think anyone wants to budget and hyper analyze every expense in their life because it just gets stressful. And so I think the key is kind of do this automated savings plan, and then you don't have to, but you got to have enough margin to do that. And that's where that seek out higher income streams probably comes in. So I think the last thing, this invest money as soon as you get it. So I think that is true for most people. Like that's a good rule of thumb. I'm sure you guys do this and talk to people. They're like, yeah, I have like $1 million saved. Like, what should I do with it? Right? We get those kind of conversations all the time. And that's great that you can save that much money, but did it take 10 years to save that much money or 5 years? And could it have been sitting somewhere growing, right? Whether it's in index funds or whether it's in a piece of real estate, doesn't really matter. There's always an opportunity cost to hold cash in savings. And so the one caveat to that is invest money as soon as you get it. For me, is that if I'm not saving up enough to invest in bigger deals, I lose out on those opportunities to invest. And so that's kind of the real estate game, though. It just depends if that's the game you're in.
Yeah, no, good points.
Yeah. And I think too, especially if you're looking at those bigger investments, I feel like a lot of people, they have their practice account, they have whatever, and they're just slow to even move the money out of some of those things. So even I think when you're saving for larger purchases, you're wanting to have that, the gunpowder on the side, getting that money, at least moving it into what we talked about in the first conversation, getting it in those money market accounts, get it in something that at least you're making a little something off of it. And so even if it's not going to move the needle in a huge amount, just I think being conscious of where your money is and the type of returns you're getting, opposed to, just being passive and letting it sit places where, it's just being eroded by inflation.
Yeah. Okay, these are good points. I think what's good here is we're at different phases in our life. Reed, your oldest kid is
2.
2. Okay, my oldest is 10. So when Reed's talking, I'm like, I remember those days. So I'll have a little different perspective just because I'm in a little different place in my life. So pay off high interest debt now. I've never seen one of my dentists, right, that comes and talks to me. Like, I've never seen somebody paying off debt aggressively. And like my gut reaction was like, that's probably not a good idea. Um, so I think like paying down debt aggressively just frees you up in life. And so I will say, if you're doing this, that's never a bad idea. So don't fault yourself for doing that. Okay, it puts you in a very good position, and it puts you in good mental health not to have that debt burden there. Okay, I will say too, like whenever an investor or potential investor reaches out to me, and or I'm having like my yearly investor calls with my investor, I go through these 5 things because if these aren't being done, like there's no point in investing. So like these are like the tickets to the ball game, right? Especially the younger investors. Most of them, we talk about things, we come up with a plan for their CE, not so much for investing because you got to get that income going first. So pay off high interest debt now. I agree with Reed here on consumer debt, right? If you're buying a car, buy it with cash, right? Like, don't buy, if you're driving that Honda Accord from dental school or whatever, that old car, don't buy the new car until you can buy it with cash. Okay. One consumer piece that you can buy that I think is okay is an entry level home. Okay. Like your life has to start at some point, right? And a home is a very important part of that for your family. But outside of that, I agree 100% on the consumer debt. Um, One thing that I didn't realize that I've kind of realized now is we went from starter home. Okay, it was getting kind of tight for us. We loved our home, but we were like, my wife and I, like our one vision was having a big, beautiful house, right? That was like our one thing. Like we picked our one thing that we wanted to spend money on. And then we ended up buying like a ski lake condo too, because we already joined the ski team for our family in the winter, right? Like we wanted to have something for our kids to do, or our family to do together in the winter. So I bought those 2 things, and I bought them leveraged because the same concept that Reed had. I was like, well, I make more money on my returns. Why wouldn't I leverage these? Part of me now is like, oh, this is kind of consumer debt, buying the bigger home and then buying the ski condo. So, I'm kind of at the point now where if somebody's like going to jump from that starter home to the bigger one, I'm almost like, hey, unless you got a really low interest rate, you may consider this as a consumer spending and have the cash before you do it, because there's opportunity costs like Reed mentioned there. So establish an emergency fund for liquidity. This is the first thing I talk to people about. Like, how much cash do you have in your personal accounts? How much cash do you have in your business account? And then what liquid assets you have. So equities like index funds that are not in a tax advantaged account, you can sell those immediately, right? And get cash. So I always want to make sure that people have enough cash so they're enjoying their lives, right? There's enough stress running a dental office. I don't want you stressed out because you don't have enough liquidity too, right? So liquidity is always like a check box before we start looking at investments. Mercilessly cut spending. So when you're a dental practice owner and you're just churning off a ton of income, every time you run these little analyses, I was the same as Reed. I was like, like I don't really need to budget because our spending is so little compared to our income, right? And then we're just taking that income and reinvesting it. I have a business account that's in a high yield, right? So I just shove my extra money in there and I deploy it from there, like Reed does, and I get distributions and I deploy it back into that account. One of my buddies calls it a war chest, right? I like that one. So the war chest, right? So make sure that's high yield. I agree with that. Seek out higher income streams. This is what we talked about. Own a business, learn the business, learn dental insurance, learn to sell as a dentist, learn skills, right? Implants, other things. Invest money as soon as you get it. So she focuses on like stock investing.
Dollar,
Okay.
dollar cost averaging,
Yeah,
basically.
yeah, dollar cost averaging,
Yeah.
that kind of thing. If that's your thing, great, do that. Do invest it right away. But in real estate, you need to say no to the good so you can say yes to the great. And so it's a little different there.
A little different.
Last couple things she talks about is like wealth tracking, a financial freedom calculator. Yeah, I run those numbers so I kind of get a sense of where I'm at. It sounds like Reed runs those numbers as well, like his property, so he knows where he's at. Wealth tracking, there is no software I found that like tracks my wealth like I like it. So I just use a Google Sheet, right? And I update that. I update my personal financial statement every quarter. It kind of gives me a sense of where I'm at as far as cash. It gives me a sense of like my investments, like where they're at, what I'm going to do with them this year, what I'm going to do with them quarterly, right? Am I going to sell this one? Am I going to refi this one? I just go through that quarterly. It lets me look at my credit score, make sure I'm like, um, you can't fix what you can't see, right? And then all the time, the banks are always requesting my personal financials for whatever loan or loans I have, they want like a yearly update. They're required to do so. And then new loans I'm getting, right? So what I do is I have the same spreadsheet with all these other tabs, but it feeds into my personal financial statement. Very simple, very clean, assets and liabilities. And then I have a little signature at the bottom that's just in there, right? And then every time they want me to do their personal financial statement, no. I just
Yeah.
print off mine, I go to theirs and I sign theirs and I send them mine, right? I'm not wasting those hours. Are you kidding me?
Yeah.
So I'd highly recommend that as well.
That's hilarious. That's hilarious. That's just like exactly like what I have to do because I'm just like it takes so long to even update a personal financial statement, let alone draft a whole new one. And it's just, oh my gosh, in the mental headache of like, did this Excel box break? Why isn't this summing, like they send you? So that's the one nice thing about real estate is if you have some debt, it forces you to update your personal financial statement on a regular basis. Before real estate, most people don't do that, because most lenders for consumer lending, buying your first home or whatever, are just going to be like, send me your tax return, right? But if you do more investments where you're taking on debt for real estate, buying commercial properties, you're going to have to do lender compliance, which involves that personal financial statement. So
Yep.
everyone should do one. I think you're right, Josh. It's just a great way to kind of see the whole picture. And it's kind of fun because you get to see year to year, like, oh, we grew here or didn't here or whatever. My stock market portfolio is a little down. Real estate's a little up, but yeah.
What is tracked improves,
Mhm.
right? We learned that on KPIs on dental metrics, right? It's the same thing with your income. Okay. Andrew, any final comments for today?
Oh yeah, I liked what you said. I think you guys are more Excel wizards than me. Those have been skills that I've been trying to sharpen and strengthen. But yeah, I've used the Mint app and Empower and thing. It is nice having everything in one spot where you can track and you can follow. I agree, nothing's perfect, but as you said, the more there's just so many different things happening. It's good having everything in one place, and if you're not watching it, it just slips away. And so I agree with everything that you guys just said.
All right.
Josh, someday we'll have to debate debt a little bit more.
Sure. We can make that a topic. Debt.
Yeah.
Uh, all right, guys. Well, that was How to Build Wealth Fast, part two. I think that was fantastic content for our listeners. And that's a wrap. Three, two, one.
Clap.
All right, guys. I have an investor call in 1 minute.
Yeah.
I built myself a 15-minute buffer just in case. And
Needed it.
if you need anything from me, like text me. Like I said, I got that project just got lending, so now I'm like all in with all the subcontractors, going through all their bids, and we just cut one like 200 grand, our first one, yesterday. I was like, dude, that went from 9:30, and this is our best one. So from 9:30 to like 7:40, on our dirt guy. So micromanage those bids
Yeah.
when you're doing your developments. So good.
Well, good luck. Yeah. Thank you.
See you guys. Bye.
Yeah. Have a good
Hey
weekend.
guys.